record. What we're going to do today is go through CorpWorks inputs, and then on Friday we're going to look at all of the output, get into taxes, the payment of dividends, estate freezes, all of those sorts of things. So to do this, what I want to do today is actually start with a brand new case right from scratch, a corporation right from scratch. And I'm going to do it in the sample file. We're doing a release today, and it's being delayed a little bit. So there's a certain feature I won't be able to actually illustrate, which is importing shareholders from VisionWorks. So I'll have to do that by referring to an existing file. So on the About tab, what I'm going to do is I'm going to click the Add button. You can see the corporation is selected. I want you to notice, by the way, that you can also do joint ventures and partnerships, but we'll select OK and set up a new corporation. And note that you have a choice to make it a holding company or an operating company. This isn't exactly overly necessary in the sense that it relates to taxes, passive income, active business income as a percent of total income, and so on, and the small business deduction. But VisionWorks calculates that automatically. So in that sense, you don't really need to select operating or holding company. However, when importing into VisionWorks, because of the lifetime capital gains exemption, we need to establish that it's a holding company. So I'm just going to call this corporation GHI. The incorporation date is not really all that necessary as long as it's before the current date. The year end, on the other hand, is very necessary. So with people, it's of course the tax year end is December 31st. With trust, it's December 31st, except for what are called graduated rate estates, which is a trust that's established in the first 36 months after somebody's death. So that is then for the first 36 months. The year end is then the year or the date of death, and at 36 months, that year actually has a stub year. There's a part tax calculation up, for the date of death, and then there's a part tax calculation through to December 31st. Show output until is fairly important, and my recommendation is that you make it 3 or so years after the life expectancy of the longest lived shareholder. So if we're talking about Bill and Sue, then if Sue's expected to outlive Bill, I would make the show output year just a few years after Sue's death. And this is only in the case that the corporation is going to continue. We have to end the output at some point, the show output until year, because of course the corporation is perpetual. And what we want to do is we want to have the output generated for a few years after the death of the second main party in VisionWorks. So even if Bill owns all of the shares, he passes them to Sue on his death. She retains those shares and eventually, let's say, passes them to Bill Jr. So we need the show output until year to last a few years after Sue's death so that we can see the impact when Bill Jr. receives the shares. Of course, you could make it longer if you wished. And then obviously jurisdiction for tax purposes. And then the number of full-time employees, of course, is important if you're talking a real estate company, and it needs to be 6 or more for active business income. And then whether it's a CCPC and if you're claiming the small business deduction. The associated corporation, if you've got a number of corporations, means then that you've got to apportion the small business deduction amongst the different corporations. So I'll leave that as is. As far as capitalization is concerned, when we're talking shares, we can go in, click the add button, have common, special, preferred, and then for each we can, if you open the list and scroll to the top, you could have plain, common, ABC, same with special, same with preferred. So I'm just going to make this 100 shares, and I'll make it voting shares. And then I'm going to enter the issue price per share. So we have that times the number of shares gives us what's called the paid up capital, the PUC. And this is a little bit tricky, something that we'll probably discuss in more of a one-on-one conversation. But the bottom line is, if we've capitalized the company by purchasing shares, put money into the company through the purchase of shares, whatever we put into the company, we're entitled to take back out tax-free. So that's the PUC. And one of the things that I'll just mention is that the PUC of the shares stays with the shares regardless of whether or not those shares transfer hands, and regardless of the price that the shares transfer hands. So it's the original seeding, if you will, of the company. The other thing that I'm going to do is I'm just going to add a preferred shareholding here, and I'm going to make it 100 preferred shares. And again, if the original common share, these preferred shares are ones that we're going to assume were issued in the past pursuant to an estate freeze. So if I own common shares, if they were redeemed by the company, and I'm issued preferred shares in place of those common, then the PUC of the original common shares that I seeded the company with, it's transferred to the preferred shares. So again, it's the ability to take that original seed capital, if you will, back out of the company tax-free. So I'll make that $1 and the PUC then is $100. Now, if these are preferred shares that were issued as a result of a previous estate freeze, what I need to do is right-click, select previously issued due to estate freeze, right-click again, you can see the checkbox against that first entry, and then select estate freeze, so that this indicates these are shares that were the result of an estate freeze. If you go to Help, in Page Help, you will see the instructions are here, and using the capitalization tab gives you a general comment, and then it gives you all the specific instructions, so everything that we have just spoken about. The other thing is that a company, of course, can be funded not only through the purchase of shares, but as a consequence of lending money to the company. So I want to just put in some debt because I want you to notice that we could have a maturity date that's many years in the future, or virtually not at all. But I'm going to make this 2040, 20 years from now. So if this debt is going to be issued, let's say next year, then what I want to do is put in a term of 19 years, meaning 2040 minus 19 means that the debt will be issued in 2021. If this was debt that was used to fund the company at some point in the past, then I need to put in the term previous to the current year. So 2040 minus 21 would make it 2019. And then, of course, I can put in the face amount of the debt and apply any interest that I wish. So I'm going to put in 1% for now. When it comes to shareholders, key employees, the shareholders must be imported from VisionWorks or TrustWorks unless it's a shareholder that you're really not focused on. So let's say it's a company with a few different major shareholders. Your client is Bill Smith, there's also Jack Jones as a shareholder, for instance. We needn't import Jack Jones from VisionWorks if he's not a client of yours. All we need to do is go to the add button, indicate he's a person, click enter new, and then we could put in details for Jack Jones, you know, his name, the number of common shares he owns, and so on. We really don't need any of the contact information. However, if the shareholder is Bill Smith and you've got a plan for him, then what you need to do is import Bill Smith from the VisionWorks plan. Or in the case of a trust that owns the shares of the private company, you don't need to set up the trust in any great detail, but you do need to complete the about page for the trust in order to at least set it up basically. And then you have the ability to go and import the trust. So you can see there's a sample plan for TrustWorks. I can select the base case, and then I can import the trust as a shareholder of the company, such as the Smith Family Trust. So I could do that if I wished. And then what I would do, having imported, is I would click the add button. And I want you to notice that I need to open the list. Am I, is the shareholder a person, a corporation, or a trust? And if I select trust, then we can see the Smith Family Trust. The reason that I don't think I can manage VisionWorks is because this version of CorpWorks is not compatible with VisionWorks at the moment, just because we're doing the release. So I had a version of VisionWorks this morning that I needed to test. So that was the latest version, but I didn't need to test CorpWorks. So these aren't compatible. So what I'm going to do is I'm just going to click Finish for a moment, and then I'm going to go to ABC, click Edit, and you can see now that I could click, sorry, I can't do that. Having imported Bill Smith previously, he would then be in the Bill Smith list, or sorry, in the shareholder list, and then I could just select him from that list. So sorry about that. I'd hope that we would be able to do that today, but that's not the case. So I'm just going to leave the shareholder blank for now. As far as key employees are concerned, again, you know, we would go in, click the add button. Once we've imported people from VisionWorks, then they will be available in the list. I think actually I can do this. So I'll import Bill Smith as a shareholder, and then I will import Bill Smith as, because he was already imported for ABC and DEF, so he is available. So I'll make him the shareholder of all the common shares. One thing that I just want to point out is that, and this is a little inconvenient, but it relates to auto withdrawals, which we'll talk about on Friday. Let's assume for a moment that we have 100 common shares outstanding and that Bill owns 50 and Sue owns 50. If we're using the joint primary account and joint non-registered portfolio in VisionWorks, then both Bill and Sue can own common shares, because when we pay dividends, we're going to pay them out to top up the joint primary account in VisionWorks. However, if we're using individual primary accounts and individual non-registered portfolios in VisionWorks, then auto withdrawals really won't work properly, because Bill's need for dividends can be quite different from Sue's need for dividends. And therefore, even though they both may own 50 common A shares, what you'll need to do is you'll need to set up the capital structure as 50 common A and 50 common B, so they can have different classes of shares. So when we do auto withdrawals, we're able to auto withdraw it for Bill and separately auto-withdraw different amounts for Sue. And the only way that's achievable is to have them owning different classes of shares. So I realize that's not their actual circumstance, but it's necessary because of the whole auto-withdrawal mechanism, which is in fact very complex. So that handles setting up the basic corporation. By the way, when I go to the map tab, notice that we don't see GHI because we just created it. So this first button allows me to recreate the map, and recreating the map now adds in GHI, DEF, and so on. I'm just going to delete the Smith Trust. So we can see Bill owns the common A of ABC. ABC actually, sorry, let me move this, owns the 200 common shares of DEF. That's the holdco and the opco. And then separately, Bill owns the GHI that we just set up. By the way, when you're moving these elements around, you can press the Control key and the arrow keys on your keyboard, and you'll be able to move those elements a pixel at a time in order to get them all nicely aligned. When you're dragging, they drag, based on the grid, so it's not as fine a level of detail. So here I can actually use Control and the arrow keys to move everything and have it look nice and neat. And then once I've done that, of course, I've got to click Save. As far as settings is concerned, same thing as VisionWorks. Notice, by the way, that we're using 2% inflation now. This is the FP Canada's rate for this year, down from 2.1. And inflation US dollar real estate rates, the same as in VisionWorks. So let's go down to entries and have a look. If we jump to assets, everything is essentially exactly the same as you're used to in VisionWorks, portfolios, rental properties. Life insurance here, you'll notice, because we're talking assets, are those policies that have a cash surrender value, because they represent an asset for the corporation. If I jump down to expenses in life insurance, these are the policies that are all term policies, no CSV, therefore they're an expense and not an asset of the corporation. As far as the primary account is concerned, in a corporation you can use it as that combined primary account, bank account, and portfolio, or if you wish, you can use it as a bank account, and then VisionWorks will automatically set up an other portfolio. When it comes to transferring money from the primary account, cash sources minus cash uses, if there's any excess, moving that excess into a portfolio so it earns a return. If we go to transfers into, in this case, the contribute excess cash flow checkbox is selected because we just have the one portfolio, but you could have multiple portfolios. Maybe a corporate portfolio is with a money manager, so the money isn't going to any excess cash isn't going to flow in and out of it, or any withdrawals flow in and out of it. You wouldn't want to be calling the portfolio manager every quarter saying, send me a certain amount of money in order to pay dividends. So you could have more than one other portfolio, and you could select one of those where the cash flows, move in and out, and then have other portfolios which are just left on their own. And if you go to solutions as far as withdrawing money out, if we go to tactics and withdrawals, you'll see that automatically auto withdrawals is set up and the other portfolio is selected. So automatically money will come out of this portfolio to top things up. But again, if we had multiple portfolios, we could deselect the checkbox for some of them if we wanted to. So let's go back to entries, and we'll continue to work down through some of these entries. I want to, for a minute, touch on the OpCo holdco situation, and that's really the ABC and DEF. So in this file, DEF is an OpCo owned by ABC. ABC is the holdco owned by Bill. If I go to ABC in general corporate, you'll see that the DEF shares are there, and that entry is set up automatically. As soon as you enter on the About page, ABC shareholdings, DEF, that DEF is owned by ABC, automatically this is set up. However, what is not completed is the buy table. And in the absence of the completion of the buy table, any dividends that DEF pays to ABC won't flow to ABC until you've completed this table, or DEF's value won't show under ABC's equity until you've completed this table. And the reason for that is that companies are perpetual, so DEF could have been around for a very long time, and what ABC actually paid for it could be quite different from the original issue price of the DEF shares. So we have to consciously go in and say, you know, what did ABC pay for this, and therefore what is ABC's ACB. So let's go back to GHI. I want to go down to income now, and we'll just create a business. And notice that we could add different assets, equipment, vehicles, whatever it might be. Also, we could add a building. I'm going to talk about buildings later by using a rental property. But I wanted to just touch on this. Essentially, a business and how it works, income, expenses, is the same as self-employed income in VisionWorks, or obviously a business here, or a business that's owned by a trust. So when we look at gross sales, and I'm going to close this telephone number now, assuming everybody's aboard, I'm going to bring up an income statement and just run through it. So you can see that in the income statement, there is one line that says sales or gross revenues or whatever it might be, but generally it'll just say sales. So that's what we want to enter under gross sales. It's very straightforward. If we look at expenses, you can ignore depreciation. Now, the reason is in our planning software, as distinct from tax software, what we're doing in planning software when we have an object like a rental property is we're actually depreciating the rental property and putting that depreciation charge inside the rental property, so to speak. So it's directly related to the rental property, whereas depreciation here would be the depreciation for all assets that the company has. So just to show you what I mean, and we're going to come back to rental properties. I'll create a rental property, and you can see these are just the default numbers. It's being depreciated at 4%. If I go to net cash and drill into cash sources in the rental property, what I'm going to do is I'm going to open a table, and you can see gross rent, property taxes that are deductible to give us net rental income. And then we have the CCA charge related directly to the rental property to give us the net rental income. And the reason we're doing this is because this rental property, from the time we originally purchased it, we might have gone in and done renovations to it, which could change the undepreciated capital cost of the rental property. as compared to, what we originally paid and the subsequent depreciation charges. So it's very specific to that property. So we want to make that calculation internal, so to speak, to that particular rental property, whereas in the income statement, depreciation is a tally of all depreciation charges for all assets that we depreciate. So you can ignore that, and then really it's a matter of eyeballing these different entries and deciding if they are, if we go back here to our income, deciding if they are a fixed expense or a variable expense. So you have the option, if you wish, to go to expenses and to itemize individual expenses, let's say marketing, advertising, and promotion. The issue with this is that if the client says, let's say the client's a doctor and says, at some point I want to start working half-time, that's the business within the corporation, the doctor's gross revenues may change, obviously, working half-time. The fixed expenses, office rent, telephone and utilities, whatever they may be, wouldn't change, but variable expenses could change. So if we go and model the individual expenses, the issue that we have is that we would, if the doctor said, I want to work half-time, we would have to go to all of those individual expenses and make some adjustment to the variable expenses. And that's just, very tedious. And then the doctor says, well, maybe I won't work half-time. Then we'd have to go back and change it all. So the approach that we've taken is to go in, tally up all the fixed expenses. So if we look, fixed expenses, might be things like bank charges or office expense, for instance, telephone, that sort of thing. And then we could tally up all the variable expenses, which would be things like advertising and promotion, travel, those sorts of things. You can see meals and entertainment are separately accounted for because, of course, only half the meal our portion of the meals and entertainment expense is not deductible. The one other thing I will point out, though, is that accounting and legal, we might be tempted to put in as a fixed expense. I always have to file tax returns, for instance. But I'm going to suggest that those expenses be entered under corporate and fees. And the reason for that is because the company is perpetual, so as long as it exists, we're going to have to file a tax return, so our accounting fees will go on forever, but the amount that we pay for them or the legal fees that we have, et cetera, could be very different once we retire and we no longer have active business income. So I think it's smart to carve out the accounting and legal separate from all of the other expenses that we want to itemize. But other than that, this makes it very easy when we have fixed and variable expenses. We could then go in and change the sales at some point. Our fixed expenses would remain the same, but our variable expenses, which we tally up, we total, and then we express them as a percent of gross sales, those variable expenses will always remain that same constant percent over time. And then notice, of course, here that this company is, if it's a manufacturing company, we're going to leave it to our children. It's perpetual. It's going to go on forever. So it's going out to that show output until year of 2070. But if I'm dealing with a doctor, for instance, who wants to retire in 2030, then I would want to drag the end year for sales back to 2030. And notice when I do the fixed expenses, automatically now end in 2030. So again, this is very similar to a rental property in the sense that I can now drill in to sources. There's the business, drill into income and business income, and we can see the gross expenses, fixed, variable, whatever we've entered, meals and entertainment. Notice half the meals and entertainment in this case are added back in order to come up with net income for tax purposes. So let's just close this. The next thing I want to do, so we've looked at income. We'll come down and we'll look at expenses in a moment, but I want to go back to assets, portfolios, et cetera, are all very straightforward. But I want to talk about rental properties because this is a concept that I think is very important to grasp. It applies equally to a rental property in VisionWorks or in TrustWorks. So when we go to the buy-sell panel, what we want to do is we want to put in whenever the rental property was bought. So I'm actually going to make this 2015, and then we can put in, the amount we paid for it. And I want you to notice that these tax values and net worth values changed when I changed the purchase date. These fields on your software should be gray in color, which means that they're disabled. You cannot edit them. These are calculated fields. So what we need to do is look at the building land details panel. And what you'll see is we've put in the original cost of the building, $240,000, and the land, whatever that breakdown might be. When it comes to the class, 4% per year, if you open the class list, there are different choices. 4 is fairly standard. If the building is not being depreciated, you would select NA, not applicable, and then no depreciation will occur. But basically what I want you to notice is by using the 2015, the building at the time cost $240,000. It's being depreciated at 4% per year. So the undepreciated capital cost, the amount yet to be depreciated, is $199,000. The building value, however, for net worth purposes as compared with tax purposes is $267,000. And we arrive at that by taking the $240,000 that we paid for it originally and applying the appreciation rate that we want to use for the building. And we default to it just being equal to inflation. You could make it whatever you want. Similarly, the value of the land is $60,000, and we bought it in 2015, and it's showing that the current value is $82,000, and we arrive at that by taking the original $60,000 in 2015 and then applying an appreciation rate on the land. And that appreciation rate, by the way, is whatever we're using for real estate growth rates for the province of residence. The issue is that these are calculated values. And what we could have done since 2015, for example, is we could have gone in and we could have done a number of renovations to the building and so on, which would then change our capital cost and therefore our undepreciated capital cost. So let's assume we made some renovation at some point in the past. So the important thing is here we have the ability to go in and override those calculated values so that we can enter what we believe the current value is. So the UCC of the building would be something that we would get from the previous year's tax return. Let's just arbitrarily say that we put a lot of money in last year, so the UCC is now $260,000. And then as far as the building value is concerned, again, in the land value, we can overwrite those calculated values that apply the appreciation rate since purchase, and we can put in whatever we want to put in for these. So maybe we'll make this $350,000, for instance, and maybe we'll make this $150,000. So we have the calculated values, and then we have the ability to overwrite them. On a go-forward basis, when it comes to what is the value of the rental property, we're now going to take our $350,000 building and we're going to apply the appreciation rate on the building on a go-forward basis, and we're going to take our $150,000 for the land and apply the land appreciation rate on a go-forward basis. And then you can see we express these, by the way, in constant dollars because inflated dollars get pretty insane. So you can see the $350,000 remains the same because our appreciation rate on the building is equal to our inflation rate, but the value of the land, looking out over the next 50 years and appreciating it at 6% per year compounded means that the land is worth a great deal of money. So now if we go back to the building or the buy-sell panel, we can see we have a very different set of values now for the current value for tax purposes and the current value for net worth purposes. And you can see the net worth purposes are our 350 plus 150, and the tax purposes would be our 250 plus the, 260 plus the 150 would give us then the net worth for tax purposes. So I wanted to run through that. It's a bit tricky, but basically current values are calculated, and then we have the ability to, because we could have had this building for years, so then we have the ability to go in and overwrite those calculated values with what our understanding is of the current values. And of course, the UCC is right off the previous year's tax return. So that was one of the things that I wanted to go through. The other thing that I will just mention, and hopefully you're familiar with this by now, is that other than general financing expenses, what we're doing is we're always associating a financing cost with the specific asset. So if I go in now and create a mortgage on the building, and we'll just leave it as this default number, what ends up happening then is if we go in to our rental property and drill into it and look at the table, we have the gross rent, $24,000, property taxes, operating expenses being deductible, giving us $16,400 of net rental income. And then notice that the interest is $20,000, and that can create a loss. But if I make this a little bit less, just for illustration, so we'll make this $200,000, that now when we go in and we have a look, what you'll see is that the deductible interest is deducted from the net rental income, and the CCA, what did we say? The UCC right now is $260,000 at 4% per year would be what, $9,600, but it's in fact limited because it cannot turn net rental income negative. So that's all handled, but it's the key reason that we, or one of the key reasons that we associate liabilities with a specific asset because of this impact it has on the CCA calculation. And therefore, we're going to use this CCA calculation deducted from the UCC and then, carry that UCC forward. So let's just take things from the top. We've looked at assets, we've talked about portfolios. I've just noted that life insurance is exactly the same as VisionWorks, but life insurance under assets, those policies that have a cash surrender value, otherwise they're under expenses. And then, personal property, residences, all of that is the same as VisionWorks. If we go down to expenses, because we itemized the key employee salary, we now see it as being set up, and it will be automatically imported into VisionWorks. You can see it's for Bill Smith. So my recommendation to you would be to right-click, click Edit Text, and then change this to Bill's salary, just so that in all of our output it's very clear. We could have a few different key employees, so we want to make sure that that's clear. And then notice that this is going to go on. So it's independent. We're going to, if we've said Bill's a doctor, he's going to hang up his skates in 2030, we will have to adjust this, you know, to reflect when he's going to retire in 2030, when the operating business is no longer going to be generating income. So just be aware of that. We haven't linked that to the business, only because we could have a number of key employees, and it doesn't hold that they necessarily all retire at the same time. So, you know, we could have Bill Jr. as a key employee, the corporation continuing to earn revenues well into the future, but Bill himself as a key employee wants to retire in 2030. So it's not necessarily something that can be linked to the end date of the gross revenues of the corporation. A couple of other things that I just want to look at, and then we'll throw things open for questions, is everything that has to do with tax. And with all the tax changes that have happened, this has gotten, frankly, pretty complex. So the software will handle it all as long as your inputs are accurate. So I want to just touch on the balance sheet. I think it's important to put in retained earnings, whatever they might be. So keep in mind that the way retained earnings work is that they are after-tax earnings that have been retained by the company after the payment of dividends. So to make our math very easy, revenues are $100,000. We'll just say taxes were $50,000. That leaves $50,000 of after-tax income. I pay a dividend of $25,000. I retain $25,000 in the company, and therefore that's available in the future for the payment of dividends. My retained earnings and my cash in the bank do not have to be the same by any stretch. So in order to be able to understand what is in theory available to be paid for dividends, we need to put in the retained earnings. I would not put in accounts receivable and payable. They're merely year-end accounting conventions because, you know, at the year-end, in this case, December 31st, we haven't received all income that's owed to us. And similarly, we haven't flattened out our payables, paid everybody, all of our suppliers. So in order to do the balance sheet, we need to account for receivables and payables for the balance sheet to balance. If you want to do a balance sheet, and I don't recommend you really do it, balance sheets are very creative things. But if you want to do a balance sheet, I would create a separate solution, use receivables and payables, and use that solution just to generate the balance sheet. But from an ongoing business forecast, what's the company going to earn, you know, what's available for dividends in the future, et cetera, we don't want to use receivables and payables. They would only apply to this year. We just want to assume everything is settled as of the corporate year end. When we go down to province of residence, you know, that's all very straightforward and can change over time. But if we go to deductions, reductions in the small business deduction, this is where you really need to
listen to your webinar, Rochelle.
Sorry, somebody's unmuted. Can you mute yourself? *6, please. Wait, I'm going to have to find out who's unmuted here and mute them. Oh, okay, I think we're okay. So the small business deduction, this is, all under the new rules, and the software will use, in the absence of you completing this, which is to say looking at the previous year's tax return, Schedule 7, Part 2, line 745, which is what you want to use for the calculation of 2020 taxes. In the absence of doing that, the software will use the current year value, but that's actually not correct. So it's doing that just in order to be able to have a value for the aggregate investment income. But what you really want to be able to do is you really want to go to and look up the previous year's tax return, the 2019 tax return, and put in this value from Schedule 7, Part 2, line 745. So we're using the current year value just in case you don't have the previous year tax return, so we can at least, populate the tax return with something. As far as the refundable dividend tax on hand carry forward, we're past really the whole RDTOH thing. This is again looking up the 2019 tax return and seeing what the carry forward and dividend refunds are for the ERDTOH and NERDTOH. And again, that's right off the previous year's tax return. So, you need to go in and have a look. If you click Help and see also, it will tell you exactly where to go to get that data. So the carry forward is the T2 line 520, the dividend refund is the T2 line 570. So in the new world that we live in, there's just no way around getting all of these tax numbers in the absence of actually looking at the previous year's tax return. It's now absolutely critical in order to be able to, do proper calculations for dividends and tax purposes. So I think those are all of the things that I wanted to cover. There are lots of other things we could touch on. If we go to employee benefit plans, for example, you can do IPPs, you can do RCAs. But again, those are things that, we could deal with more on a one-on-one basis. So what I want to do is throw things open to questions. And again, what you'll need to do is just press *6 in order to unmute and ask a question. So, questions? We have covered a lot of territory. I am recording it, so this will be available so you can go back and review it. So questions, please? Anything? Let's go to other assets. We'll go to ABC and DEF. They're connected corporations. I just want you to notice intercorporate loan. So if ABC has lent money to DEF, then in that case, it would be the intercorporate loan would be an asset of ABC, so we can enter it, and you can see it shows the ownership. What we have to do for DEF is set up the actual loan, what it owes ABC. So we go to DEF, go to the primary account, click intercorporate loan, and then this is where we can go in and say, the initial payment date was 2020, make it 60 months, whatever the numbers might be, $50,000. You could, by the way, make this perpetual. You could make it 900 months. And then you have a choice of interest and principal, interest only, and so on. So we'll just make it interest only, and we'll make it a couple of percent. So now we have the loan set up. This is the liability that DEF has. So if we go to equity and drill in, we can see we haven't got anything in here for assets for DEF, but we can see that we now have that corporate debt, that liability for DEF. Then what we would have to do is we would have to go to ABC, and then under other assets, the intercorporate loan, what we need to do is indicate which of DEF's loans was actually made to DEF from ABC. So now we'll select the debt, open the list, select DEF. There's our 60 months, 2020, $50,000 loan. So now that we've selected it and we look at ABC, then we can go and have a look under assets, and we can see that one of the assets that it has is the loan to DEF, and you can see it's 60 months, 5 years. So that's one other thing that you will likely come across. So just remember that the asset is under other assets, so it would be ABC's asset. It loans money to DEF, and then to create the actual loan itself, we have to go to DEF, the primary account, and set it up as a loan, not dissimilar to the other liabilities that you can set up here. So let's go back to GHI, and hopefully somebody has cooked up a question. Please. Anyone? Remember, *6 to unmute.
Hi, Michael. It's Brian Walling.
Hi, Brian.
I just have a question. Hi. I just have a question.
Glad you're on. Glad you're on today.
Thank you. I just have a question. I have several clients that just want to see a simple plan from the perspective of all they're concerned about is investing the cash, the retained earnings. So they have a corporate business account set up, and they have a set amount that comes in every year. And is there a simple way of just modeling that and removing expenses and buildings which aren't part of the scenario, so that we can at least start to show, hey, if you just want to use an insurance strategy for half the cash flow coming in, or investing it, okay?
Absolutely.
What's the simplest way to do that?
So in that case, we're not going to be concerned with the operating business and all the rest of that stuff, right? So if we, in this case, we've got ABC as our holding company. So we won't worry about its shareholding of DEF or any of those sorts of things or whatever. So what we want to do is just set up the portfolio that it has, whatever it may have in it, and whatever the return is that it's got. And then what we wanted, and if they, let's just arbitrarily say, they're getting $100,000 a year in the door, I don't know, from some operating business or something, and we don't want to get into the weeds around the business. Then all we need to do is we need to go to income, and then we can go to other taxable. And notice there's other taxable and there's other non-taxable. But notice these little down arrows. The little down arrows mean there's a menu. So in this case, if I open the menu, I can put in an ongoing entry, which just continues over time, or I can put in a discrete entry, which is a vertical bar. And I can repeat vertical bars, just left click, put in the vertical bars if I want to. But what you'd want to do is you just want to say, the operating business is, going to throw off net, a certain amount every year, that $100,000 a year. Or, and I would prefer this actually, what I could do is I could just create the business, put in the gross sales, $100,000 a year, and then make the fixed and variable expenses and everything else zero. So I've got X amount in my portfolio. I've got $100,000 coming in every year, probably from an operating business. So I just need to put in the gross sales. and make all the rest of this stuff zero and not worry about it. Does that sound okay to you?
Yeah, it's I guess the thing that I'm trying to model with the change in corporate tax rates is that to show a client, hey, you've got $300,000 and you're going to pump $60,000 a year into your corporate investments. Well, if we implement a insurance strategy with a building large cash surrender value,
Yes.
I guess the first scenario would be to say, here's the $300,000 and we're investing it accordingly at whatever interest rate. You're dumping $60,000 a year in. Now here's a scenario. If you redirect half that cash flow to an insurance strategy, what's the benefit for the client years later as far as their cash surrender, use of cash surrender value?
But all we need to do is put in the value of the portfolio, any ACB, by the way, just be heads up about that. And then if we go down to income and the business income, we can just throw in the gross sales because, that's where that extra money's coming from, right? It's from some business I'm assuming it's coming from some business income. So we can make all the rest of this stuff zero, just put in the gross sales. We're bringing in, $100,000 a year. And then all we need to do is we just need to create the insurance policy, whatever it is, and then go in and put in whatever we're dumping into the policy. And then again, we can do this more one-on-one. But if we bought this policy, whatever the premiums are, what's the projected CSV, what's the projected ACB, and so on. And then that has us, throwing the money in the policy. And this is all going to be internally handled by the software. All the excess cash, et cetera, et cetera. That's all going to be internally handled. So that's all you need to do.
The last question I have is, I know you mentioned gross sales, but what if they're receiving an annual dividend rather than fully taxable income?
You mean a dividend from some other company or an investment dividend?
Yeah.
A dividend from some other company?
Some other company, like I guess what they do is they get paid in dividends as opposed to gross sales. So the gross sales is another operating company, and this is just their in corporate investments, and they're receiving dividends rather than gross sales.
Yeah. So the reason I just mentioned, all you need to do is set up the business and the gross sales is because we want to make a distinction in the income of the company. How much is active business income, hence the business income gross sales, kind of net without looking at the income statement versus, a passive form of income, because this all gets back into the whole tax thing, and which becomes very important. So all we need to do then is we just need to go to assets. So we just want to model some light corporate thing. We'll just go to assets, and then all we need to do is use private company shares. So this is where we've got an interest in another company. We don't want to get into setting it up on the about page, capital structure, on and on and on. All we want to do is just say, I own some shares in another company. I'm one of many shareholders and I get paid dividends. So this other assets private company is a light company model. And then all we need to do is go in and click the buy panel and say, I bought the shares in, 2019 or whenever I bought them. I have 1,000 shares, they're worth $10 a share or whatever it is, pretty light. And then I'm getting paid ordinary dividends. And the way this works is dividends are not the gross amount, it's the per share amount. So if I've got 1,000 shares, I think that's what we put in, and I'm getting $50,000, then I would make the dividend $50 a share. So $50 a share times my 1,000 shares would give me my $50,000 dividend income. Okay, so you just have to do that. That's very, super light. But then it means that, we've got all the right connections being made for tax purposes, right? The types of income and all the rest of it, because that's what all this new regime, tax regime is all about that's been going on, and why it now becomes important to do something that's reasonably decent under the hood, because otherwise we could be very misleading around, corporations and taxes and everything else.
Thanks. If anything else, I'll just ask you on a more one-on-one basis.
Yeah.
And tying up
Yeah.
the rest of it.
But I think that's all you need to do. Set up the company itself properly. Throw in the portfolio. Don't forget it's ACB. Then throw in other assets, private company shares, and then just put in, the shares. I paid X for the shares, and I get Y in dividends. That's it. And then you should be good.
Thank you.
Yeah, you're welcome. Good. Thank you for asking a question. Good question. By the way, this whole light private company thing was something that we only introduced a few months ago. Previous to that, whenever we modeled companies, it was always, the full meal deal modeling of the company. And then somebody said, well, I've got a client and he's got, a very minor position, so just some private company investments that he's made. It's not really his operating company, so to speak, just some minor private company investments. I just want to reflect those in the software. So we added this light private company model, which, by the way, is exactly the same as the private company modeling that we do in VisionWorks, which, as you can see, is not particularly accurate. If it were somebody's, holding company or operating company, their main company, but it's good enough for, sort of those minor investments that some people have. As a matter of fact, it works fine for that. Anybody else with any questions? Okay, well, thank you for your time. What we're going to do on Friday is we're going to look at solutions, and we're going to go through, and I'll leave this file. We're going to go through and talk about output, equity, net cash, capital structure, capitalization tab, all of those sorts of things. The one thing, sorry, let me go back to GHI, because you'll notice we have those preferred shares we entered. The one thing that I will mention just before we finish is you'll recall under capitalization, we put in the preferred shares that were issued previously pursuant to an estate freeze. And when we put in the issue price in the PUC, what happens is that's transferred from the original common shares that were redeemed and replaced with the preferred shares. That's the seed capital, if you'll recall, that went into the company originally, the common share investment. So that's the seed capital. So that becomes the issue price in the PUC of the preferred shares. However, what has happened is the company, 100 shares at $1 a share, $100, the original capital that we put in when we bought shares, when we did that freeze, those common shares, which were replaced by preferred shares, those common shares could have been worth a great deal of money. Let's just say in total $1 million. So this does not reflect now what the replacement price was, so to speak. It just reflects the original seed capital. So what we need to do is we need to go down to solutions, tactics, and you can see valuation, what are shares worth. So value per share here for the common shares, we're using the equity method, just whatever the shares are worth, as compared to book value. Notice capitalization of earnings, which could be a multiple of earnings, which would be typical for an advisor's book, for instance. But for the preferred shares, if we had 100 shares outstanding, and the swap, so to speak, the $1 million of common shares was replaced with 100 preferred shares, then the value of those preferred shares, what's the right math? $1 million divided by 100, what's that, $10,000 a share? So now that becomes the price of the preferred shares, the market value, if you will, of the preferred shares. So now we would see this, that's the PUC, but now that would be the value of the preferred shares. And those, by the way, are treated now as a liability of the corporation. There's our $1 million of preferred shares, because the company at some point is going to be redeeming those. So there's the value of the preferred shares on the About page, the PUC being the original PUC of the common shares that just got transferred over. But then there's, and what were the common shares that we owned and, swapped them for the preferred shares, what were those common shares worth at the time? And that was not the original PUC. That was the value of that was put on the common shares when the estate freeze was done. So that's what we need to enter here. So Friday, what we'll do is we'll look at output, and we'll start, looking at valuation and capital changes. And obviously the thing we want to focus on most is the payment of dividends. And especially, of course, we'll focus on auto withdrawals. And that requires VisionWorks and CorpWorks being linked, and the release will have been tidied up. We just had an issue today with compiling it, because these days antivirus software on everybody's computers can really mess up installations. So that's what we were having to deal with. Anybody with any other questions before we finish up for the day? Okay, thank you all for your time again, and look forward hopefully to hooking up with you on Friday. Thanks.